Very good morning, friends. So I hope you are doing well. And of course, you've made your revisions on the financial instruments, cumulative revisions, I would say. Well, I think as we start off the session today, I guess I'm going to do, first of all, a few questions with you. Because one of the areas which we discussed was the difference between a transaction value and a fair value. Typically, the concept of a concession loan, which is given by the employer to the employee, and in which particular case we attribute the difference between the transaction value and the fair value as what we call a prepaid staff cost. And that prepaid staff cost is supposed to be amortized over the period of the loan. There is a special issue which comes in this particular case. There is a question in the study material as well as a question which came in the exams, I guess, in January 21. And this was dealing with a prepayment which is made by the employee during the course of the loan. So the agenda is that if there is a prepayment on account of a concession loan, how does it impact the accounting? Because you've segregated the total loan value, or I would say the total proceeds which the employer has given to the employee in terms of the financial asset as well as in terms of the prepaid staff cost. So when the employee is going to pay you money, naturally it's not a payment only towards a loan, but there will be some element which will be adjusted against the prepaid staff cost as well. So one of my agendas, first of all, is to do a question which relates to the concept of prepayment of a concessional staff loan. Mind the words, I said there is a prepayment of a concessional staff loan. Then I'm also going to do another interesting question as well, and that is accounting of financial guarantees. If we recall in terms of the major categories of financial liability, I said basically, there are two categories of financial liability. One is a financial liability which is measured at AC, and one is the financial liability which is supposed to be measured at FPTPL. But there are more financial liabilities also, like for example, there is something what we call a contingent consideration which arises on account of a business combination. I did not make a mention of that because you'll see that contingent consideration when we come to the concept of Ind AS 103, that is business combination. But that contingent consideration which relates to a business combination is also classified as a financial liability as per Ind AS 109, and that is also considered at FPTPL. So that's like a third category of financial liability. Since I'm just making a mention, let me also add there is another financial liability as well, and that is a financial guarantee. So we are going to look at a particular question because there has been a question, I think, twice in the revisionary test papers, which is dealing with the accounting of financial guarantee, because that is going to be something different as compared to a normal accounting. So I think let's do a question on the financial guarantee as well. That makes it a fourth category of financial liability. Though I think let me also add there is another fifth category of a financial liability as well, and that is when you derecognize a financial asset, it may not result in a derecognition of financial asset, but it results in a recognition of financial liability. I did not make a mention of that as well because we are going to do the concept of derecognition. And when we come to the concept of derecognition of financial asset, you will also relate to the financial liabilities which arise when derecognition of financial assets cannot take place. So I guess I have actually given to your mind that there are total 5 kinds of financial liability. I think since we have spoken on that, so let me just reiterate that there are a total of 5 categories of financial liability. One is a financial liability at amortized cost. That's a default category. One is a financial liability which is at fair value through P&L, which is typically derivative financial liabilities or liabilities which are held for trading, or they are designated to be measured at a fair value through P&L. The third is financial guarantees. The fourth is, you can say, financial liabilities which arise when derecognition of financial assets cannot take place. And the fifth is The contingent consideration which is payable under a business combination, that is Ind AS 103. So technically speaking, if somebody were to tell me that what are the various types of financial liability, I would say it's fine. I'm not documenting that part, but I thought I'll just add on to this. So I think the focus right now is dealing with two special issues early in the morning. First of all, let's do two practical illustrations with you. So one is on the prepayment of a concessional staff loan, and the second is dealing with the concept of financial guarantee accounting. And then my focus today is going to turn on to the derecognition of financial instruments, derecognition of financial assets, and derecognition of financial liabilities. Then the other special issues will follow. But of course, I think that would follow in the next session, impairment, as well as the concept of hedging. So that would follow after that. And also a question related to the concept of how the accounting for embedded derivatives is concerned. I think when I gave you the concept of a special issue, I gave you four special issues, but technically there is another fifth one as well. And that is dealing with the concept of embedded derivatives being accounted in terms of an instrument which is hybrid in nature. So I think let's begin the journey. So I am first of all going to take you to a small little question, though the question looks a little bigger, but it's not very technical indeed. So I hope this is visible to you. I hope the screen is visible, I guess.
Yes, sir. Visible, sir.
Wonderful indeed. So let's read the question. This is January 21 examination question. So let's first read the facts of the case. It says Lovely Limited has got a policy of providing subsidized loans to its employees. Can I say immediately as I read that they're providing subsidized loan to the employees, my mind starts telling me that the contracted rate and the market rate is certainly going to be different.
Yes,
My
sir.
market rate is going to be less than the contracted rate. That's right.
Of
Leading
market.
to the concept of transaction value and fair value being different, leading to a prepaid staff cost. Correct. Then he says for the purpose of buying two-wheelers and four-wheelers, Simran, who is a sales executive, took a loan for a four-wheeler vehicle from the company, and the following are the terms of the loan. There is a principal amount to the extent of 9 lakh, and see, interestingly, the interest is 5% on the first 3 lakh, and then it is 8% on the remaining amount. So we don't have a flat interest rate. It is 3 lakhs, it is 5% on the initial three, and then you can say the remaining 6 lakhs, you will pay 8% interest. The loan is disbursed on April 17 and it has got a tenure of 3 years. Then it says prepayment is either in full or partial at the option of the employee. There is something technical which is coming to my mind. You can stop me from saying that technical thing because we've not yet covered that aspect. So you can tell me, no, sir, don't say that. It might become dangerous early in the morning. So your silence is taken as a deemed acceptance. You've stopped me from saying the technicality. Great. That's a good choice. Simran shall remain in service till the end of the loan ends. But in any case, I think we've seen that earlier as well, that any kind of conditions attached to the loan, whether you need to be in service or not, that does not make any difference to the accounting treatment. So whether she is going to continue for the tenure or not would not make a difference. The principal amount should be recovered. It says the principal amount should be recovered in 3 equal installments at the end of each year. So is this equated annual installment, or is it 9 lakh divided in terms of 3 installments, that is 3 lakhs each?
3 lakhs each.
Correct. Because very clearly it says the principal is in 3 installments, and then it says it will be first applied to the 8% interest bearing principal, which means that when the amount is paid, we will assume that the payment is made for that portion on which the interest rate is higher. So which means the remaining loan will first pay interest at the rate of 5% and then 8%. So we'll always assume, even if the question is silent, that the interest is paid on the higher portion of interest. The accrued interest is paid on an annual basis. And very clearly, it says the market rate of interest is 12% per annum. So I think we can clearly see that the contracted rate is 5% as well as 8%, and the market rate is 12%. Undoubtedly, it's an off-market transaction. And if it is an off-market transactions, the contracted rate is less than the market rate, and the implications which I said at the start would imply. Then he says the following table shows the expected contractual cash flows. So I am given the contractual cash flows which is expected to be received. So there is an outflow of 9 lakhs, and he's already given you the 3 principal installments. You can see the interest is computed at the rate of 5% on 3 lakh. So on 3 lakh rupees, if you take a 5% interest, it works out at 15,000. And then they've taken the interest on the remaining loan, that is 6 lakhs, at the rate of 8%, and that works out at 48. But then since there has been a repayment of another 3 lakhs, so the next year you'll get 3 lakhs into 8%, that is 24. And in the next year, the entire portion excess is paid off, so there is no interest. So he's already given you the principal inflows and the interest inflow, which is given clearly. And the principal outstanding is also defined. I think this, even if it is not given, can easily be computed from the information given above. Now, the crucial point is that Simran makes a prepayment of 1 lakh on 31st March 19. The loan was disbursed on April 17, and the repayment is made on March 19, which means 2 years post the loan. March 18 is the first year, and then March 19 is the second year. So second year, the loan is prepaid to the extent of 1 lakh. Then he says the following table shows the actual cash flow. Mind the words carefully. This is expected contractual cash flow, and this is actual cash flows. Considering the prepayment on March 2019. Now, since there is a prepayment, you can see that this is 4 lakh instead of 3 lakh, and therefore the remaining money paid is 2 lakhs, and accordingly the interest has undergone a change in this particular component. Because the interest is going to undergo a change in the last year, you made a prepayment of 1 lakh rupees, so the actual cash flows are given. Technically, if you ask me, I think this portion is something which one can easily compute. Effectively, the question is on the first part. Because in the next part of the question, he's only telling you the expected cash inflows and the actual cash inflow based on the prepayments collected from the employee. Now, you're required to pass journal entries in the books of Lovely. I'll make leisure accounts with which you can easily make journal entries considering the requirements of Indes 109. So this was January 21 examination question which came for 14 marks. Similar question is also given in the study material as well, and this came in the examination as well. So let's, I think, begin the journey. So let me, I think, carry on the inputs. So let me, I think, first of all, organize my data. A lot of calculations required in this particular case. Otherwise, it's a pretty simple and straight question. So just to remind you, I'm just putting the heading that we're covering a special issue. We're covering a special issue, which is accounting for prepayment. So we're covering the aspect of accounting for prepayment in case of concessional loan. I'm just putting the heading so that it becomes easy to correlate when you're going to make a revision on this, that the special agenda is in terms of accounting for the prepayment in case of a concessional loan. So that is the special agenda. So let me just make a reference to the question number. So that is question number 12. So tell me, what is the first thing you are going to do in this particular question? I'm just going to ignore the concept of prepayment at the very start. So what is the first agenda you need to do in this question? We've identified it's an off-market transaction. So we've said it's a concession loan. Other than that, what is the first focus?
We need to identify the present value of the outflows.
Wonderful. So present value of the inflows and
Inflows and
calculate
outflow.
indirectly the fair value. So first of all, what we're going to do, we're going to make a working note for the computation of fair value. And the computation of fair value is going to involve the present value of all the inflows which we are going to get. So when you're going to consider the fair value, we are doing it at the inception. So when you're doing it at the inception, I am going to consider the expected contractual cash flows and do the discounting. The chart for the expected contractual cash flows is already given, so we can easily pick up the data. So we can take 3 years, year 1, year 2, year 3. Let's take the expected cash inflow, and then we'll discount this, and this will be discounted at the market rate of interest. I think that's 12%.
Yes,
And
sir.
we will calculate the present value as well. So let's, I think, first of all, pick up the expected inflows from the question. You want me to show the question, or can I just pick up the figures from the data? The question is already in front of me. So
Yeah,
I
you
guess
can.
the expected inflows is to the extent of principal plus interest. So I think I'll just give you the figures. Maybe you can just add it up quickly. So just add this 3 lakh plus 48 plus 15, then 3 lakh 24, 15, and so on. Second year is 339, and third year is 315. Second year is 339, third year is 3 lakh 15, and what is the figure for the first year? I guess 363. So these are the expected cash inflow. Let's discount them at the rate of 12%. So at 12%, the factors would be, I'm taking 3 decimal places, 0.893, 0.797, and 0.712. So let's calculate the present values as well. This is 324, 159.
Yes, 159.
Correct. This is 270,183.
Yes, sir.
And this is, I think, 224, 280, I guess. So let's add this up. We get the present value. That is the fair value.
325. Okay. It's 8,18,622.
That's right. 818,622. That becomes the fair value. Wonderful indeed. Okay, so I think with this input, we've got the fair value. And now I think it's time to put an initial entry because we're looking at a concession loan. So before we proceed the accounting in the ledger, let's, I think, put the first entry out here. So since we're looking at the accounting in the books of the employer, we can say financial asset, brackets, I'm putting it as a loan. Can I say this will get debited at the fair value, which you have computed 818,622?
Yes, sir.
And the bank is going to be recorded with the transaction value, which is to the extent of 9 lakh rupees of loan. So the balancing figure in this particular case is going to be the
Staff
prepaid
cost.
staff cost. That's right, which is to be amortized over a period of 3 years. So let's see the balancing figure. That's 81378.
81378.
Great. So I think that takes care of the initial accounting in the books of accounts. Now I think we need to proceed absolutely in a normal manner. We need to first of all make the loan account only for the period of 2 years because there has been a prepayment of the loan at the end of the second year. So let's make 2 ledger accounts. The question is asking you to put journal entries, but I think once I make the ledgers, you can easily draft the entries from the ledger. So let's, I think, make a ledger account for ease of convenience. So one is I'm making a loan account and the other one I'm making is the staff cost. So we've got the staff cost and we've got the financial asset, which is the loan account. And we're going to make this only for the first 2 years because there is a prepayment in this particular case. We'll make the third year as well, but I think first we need to consider the input in terms of the second year. So let's begin. So this is going to be bank, and this is the fair value 818,622. What next in the financial asset account? Can I say I need to consider the interest income, which is going to be taken at the basis of the market rate of interest? Because the golden rule again applies. When you took the fair value, you did the discounting. So what we are doing indirectly now is unwinding of discount, or you can say compounding. So let's take the finance income at the rate of 12% on this. So 12% interest income comes to 98,235 approximately.
Yes, sir.
So 98,235. Can I say at the end of the year, you're going to receive the principal as well as the interest? Can I pick this from the expected cash flow chart, which we took in the fair value?
Yes,
The
sir.
figure which is there in the first year, that is 363. Yes, of course. So we pick this information, that is 363, the principal and the interest. And let's take the balance CD as a balancing figure. So let's see what is the balancing figure in this particular case. I guess 553, 857.
857. Correct, sir.
That's right, 553, 857. That is the balance BD in the next year. So again, I will accrue my finance income at the rate of 12% on this. So 12% interest will become 66,463 approximately.
Yes, sir.
And then again, I can take the figure which is there in my fair value computation at the end of the second year. And that's to the extent of 3,39,000. So we fit in this figure, that's 339. Now don't take the balancing figure at this stage. Don't take a balance CD at this particular stage. Because at this particular stage, there has been a prepayment to the extent of 1 lakh. Now, I think since we are doing revision, I think I should definitely ask you a question as well. Are you going to record that entire 1 lakh in this ledger account? Or you need to do something else? Because that 1 lakh which the employee makes a prepayment, is it attributable only to the loan account or to be split between the loan and the prepaid staff cost?
Split, sir.
Between
That's right. We need to do
Yes,
a
split.
split. So I think I'll just put the bank figure, but I'll not write down 1 lakh, but just keep it blank. Let's, I think in the meantime, also make a prepaid staff cost as well. So let's, I think, make a ledger account for the prepaid staff cost. So this is bank, and that's to the extent of 81,378. So 1/3 of this would have been amortized in the profit and loss account. So let's see what is 1/3 and get the balance CD as a balancing figure.
27,126.
That's right, 27,126.
It's 54,252.
54,252. Right, so this becomes the balance BD in the next year, that is 54,252. So 54,252, again you amortize 1/3, that is 27,126. So can I also write down bank in this ledger? Because the sum total of the bank in this ledger and in this ledger, can I say, is that 1 lakh rupees a prepayment. Once we do the split, we will come to know that out of that 1 lakh, what is to be adjusted against the loan account and what is to be adjusted against the prepaid staff cost. Okay, so far so good. I don't think so there is anything new which I have introduced in this case. It's a normal accounting of a concession loan before the prepayment happens. Now, what next? Tell me the agenda, what next? How would you do the split accounting of that 1 lakh rupees of prepayment by the employee? How do you identify what's towards the loan and what's towards the amount which is the staff cost? Any inputs? So I guess I have to answer that or the silence. So let me explain. So in this particular case, what you need to do, you need to calculate the fair value of the loan, consider what is the remaining cash flows, and on that basis, you need to calculate what is the fair value. So let's compare the amount. So let's do one thing. Let's now again do the computation. Let's do the computation of the present value of remaining cash flows. So we need to consider the present value of the remaining cash flows at this particular stage. So what is the remaining cash flows after this payment is done? Am I now going to pick up the cash flows from the expected chart, which we did earlier, or am I going to pick up the remaining cash flows from the actual chart, which is given in the question? It's going to be picked up from the actual chart. Because initially, when you were considering the cash flow, the fair value calculations, we were sitting at time 0. So that calculation was based on the expected cash flow. So I think let me highlight that point also very well. That initially, when you're calculating this, we are considering the expected cash flows at that particular stage. But now on the time of repayment, when you go to consider the remaining cash flows, we go to consider the actual cash flows after the repayment. So in this particular case, when you take the remaining cash flows, is going to be based on the actual chart which is given in the question. So let's do the calculations of the fair value. So now I think we've got just a third year, another 1 year to go. So let's consider what is the actual cash flows. And then we can discount this at the rate of 12%. And on this basis, we can get the present value. So basically, we need to get the fair value based on the remaining cash flows at the date of repayment so that I can compare what is the book value of the asset at this stage and what is the fair value of the asset based on remaining cash flows, compare the two. So let's go back to the question and let's see what is the cash flows at this stage. Can I say 2 lakhs is the cash flows in the third year and another 10,000 interest is going to be there in the third year. So we pick up the figure. This is going to be 2 lakh 10,000. So let's see the present value factor at the rate of 12% just for the first year. I think we already did that. That's I think 0.893. So we multiply this by 2 lakh 10,000, it comes to 187,530.
Yes, sir.
Right, so you need to be very systematic. It's not at all a difficult question. You just need to be very careful in terms of what information you're picking at which stage. Okay, now with this particular inputs in hand, I need to go back to my ledgers and do some comparison. Let's see what is the balance CD effectively at this stage. Though we're not closing the ledger, but we need to see what is the effective balance at this particular stage. So just consider these figures and see what is the effective balancing figure in this ledger at this stage.
281320.
Wonderful indeed. So let's pick up the book value. So I am given the book value, or you can say the carrying amount of the loan, that is 281,320. So does this mean that because of the repayment, your book value is to be converted into the fair value? So whatever difference is there, that will be attributed as an adjustment to the loan account. Yes. So let's see what is the difference in this particular case. So minus 187,530, I think it comes to 93,790.
Yes,
So
sir.
this is the amount which will be adjusted against the loan account. So one more calculations at this stage. So can I say if I now consider the total prepayment which is done by the employee is to the extent of 1 lakh rupee. And we can split that out of this what is adjusted against the loan, which is financial asset, and what is adjusted against the staff cost. So that split can be done at this particular stage. So 93,790 gets adjusted against the loan, and the balancing figure
6210.
is 6210. Wonderful. So I think now we can just go back to the ledgers and fit in this information, and then we can also make the ledger account for the third year as well. Because I think the question is asking us to put journal entry, though is not defined till what stage, but you can do it for the entire tenure of the loan. So 93,790 gets adjusted here. So this is going to be 93,790. And this is going to be, how much was that? 6210, right?
Yeah, 6210.
Okay, perfect. So I think now we are in a comfortable position to get the balance CD in this particular ledger. And we can also get a balance CD in this particular ledger as well. That would be a balancing figure. So that takes care of the accounting as far as the prepayment of the loan is concerned. So 553,857.
It's 1,87,530.
Okay, that's right. So 187,530 is the balance CD. Similarly, let's get the balancing figure for the staff cost as well. I think it's 20916.
Yes, sir.
Correct. Perfect. So I think that takes care of the leisure accounts for the period of 2 years. You want me to make the leisure account for the third year as well? Or you think you can manage that? If you say, I'll make it. If you think manageable, I'll leave that. You want me to make a leisure for third year? I think let's make it for the financial asset. Not a big problem. So let's make the leisure account for the third year as well out here itself. The balance BD becomes 187,530. Now, as far as the finance income is concerned, last year we generally don't calculate finance income. Comfortably, let's take that as a balancing figure. So tell me, how much do I write on the bank account? What is the collections in the third year?
2 lakhs.
210, including the interest. And you can comfortably take the finance income as a balancing figure, though make a check that it is coming approximately at the rate of 12%. So 210 minus 187, 530, I think it's 22,470.
Yes, sir.
Just see, is this approximately coming to 12% on the opening balance? Yes, I think there's a slight difference of a few hundred,
Yes,
200
sir.
rupees, I guess, but
Yeah.
that's approximately the same. And this balance BD, of course, will be taken in the next year. Let's also make the leisure for that as well. So this is 20916. And can I say that will be taken in the P&L? That's 20916. I think if you ask me, considering the weightage of this question for 14 marks in the exams, I think it was quite a good free marks kind of a thing. Because if anybody has, done this question earlier, which I'm sure one would do, considering that it was in the study material, I think it's a very easy question. It's not at all difficult indeed.
Yes, sir. It's look like a lease modification.
Yes, that's right. It is a modification. That's correct. But I just, technically call it as a special issue that there is a prepayment relating to a concession loan. Okay, that's great. So that was one question we thought let's practice. And now let's go to another practical illustration as well. So I'm now going to do another question with you. This is with reference to the financial guarantee accounting. So let me, I think, take you to the financial guarantee accounting. So let me know if this is visible, I guess.
Yes, sir. Visible, sir.
Okay, wonderful indeed. Okay, so I thought, early in the morning, let's do some practical illustrations, practice a bit as well, because I've taken actually, what I call as the super 20 questions. We've already done some questions out of this assignment, and we're going to do some more questions as well. Some questions, I think around almost, more than 10, 12 questions already taken care indirectly. Okay, so let's come to the question number 14, and let me just read the facts. I hope I don't need to give you any background on the concept of financial guarantee. I hope you know the concept. I'm just doing the question directly, right?
Yes, sir.
Great. It says on 1st April X1. So on 1st April X1, Sun guarantees a 10 lakh loan of the subsidiary that is Moon Limited, which the bank provided to Moon for a period of 3 years at 8%. The interest payments are made at the end of each year, and the principal is repaid at the end of the term loan. So, principal is going to be a bullet payment at the end of third year, but the interest is paid at the end of each year. It says if Sun had not issued a guarantee, the bank would have charged Moon interest at the rate of 11%. So, because of the guarantee, he gets the interest 8%. Otherwise, the interest would have been 11%, and Sun does not charge Moon for providing the guarantee. On 31st March X2, there is a 1% probability that Moon may default on the loan in the next 12 months. And if Moon defaults on the loan, Sun Limited does not expect to recover any amount from Moon. Then he says on 31st March X3, there is a 3% probability that Moon may default on the loan in the next 12 months. I'm sure you will be able to relate the language when he's talking about the probability and the default over the next 12 months. Just to remind you, he is hinting towards the expected credit loss model. Because when you give a financial guarantee, let's say to the subsidiary company, they've taken a bank loan and you give a financial guarantee, in those particular cases, naturally, the interest rate differs. Because if the bank would have given a loan without a guarantee, the interest would have been greater, 11% in this case. But if the loan is given with a guarantee, the interest lowers down to 8% in this case. So the 3% advantage is what the parent is indirectly giving to the subsidiary company. And then at the end of each year, what the parent company needs to do, it needs to evaluate that if there is any trigger of default. Let's say, for example, the subsidiary company makes a default, and the concept of default is always linked to the calculation of ECL, expected credit loss. And in which particular case, we apply the concept of what is called the probability of default, which is estimated based on a 12 months ECL or based on a lifetime ECL. So the probability of default based on the expected credit loss model is already given at the end of each year. There is a 1% probability of default. There is a 3% probability of default, and both are over the next 12 months. That means in the ECL, he is considering the default probability over the next 12 months. It's a 12 months ECL cycle. So you got to consider the EAD, the exposure at default, into the LGD, that is a loss given default, into, you can say, the PD, the probability of default, and also consider the time value of money if it is relevant in nature. Then he says, if Moon defaults on the loan, Sun does not expect to recover any amount from Moon. Provide the accounting treatment of the financial guarantee as per Ind AS 109 in the books of Sun Limited on initial recognition and in the subsequent period till March X3. So he's asking me the accounting in the books of the parent for the period of 2 years. One is at the initial recognition, and then at the end of first year, and then at the end of second year. So tell me, first of all, what will be the entry which will be done at the inception when the parent gives a financial guarantee to the subsidiary company? What entry am I supposed to pass?
We need to provide the provisions for liability guarantee.
So what entry are you going to pass in this particular case at the very inception? Provision is correct. You will basically create a financial liability, which is a financial guarantee. So what is the account which you're going to debit in terms of creating this financial liability?
Investment in subsidiary.
Wonderful indeed. That's correct. Investment in the subsidy will be recorded. So how are we going to record this? We need to put across a very simple question. So I think let me just start the initial part of the solution here itself. So when I'm looking at the initial accounting, that is on 1st April X1. So you need to first of all put across a very simple question to yourself. Had the loan been given without a guarantee, the interest would have been 11%. Had the loan been given with a guarantee, it is 8%. So there is a 3% benefit which is given by the parent. So we will calculate the fair value. We will calculate the fair value of the financial guarantee. I'm putting it as FG. So at the first instance, you need to tell the examiner the calculation of the fair value of financial guarantee and then put the entry and then proceed. So in this particular case, we can say it is going to be, you can say the interest if there is no financial guarantee versus the interest if there is financial guarantee. So we can clearly see that the interest which is given to me is supposed to be 8%, but had the guarantee not been given, it would have been 11%. So we can say that 11% minus that 8%, that 3% per annum advantage is supposed to be the fair value. So we will take the present value of that 3% for the next 3 years to come. So let's see what is the difference in the interest. So what was the principal amount of the loan? It was 10 lakh. So can I say on 10 lakh rupees, we've given a 3% advantage. And let's see the PVIFA. So can you tell me at 11%, what is the PVIFA? The cumulative factor at the rate of 11% for the period of 3 years. So that would give us the present value, that is the fair value of the guarantee. So on 10 lakh rupees, 3%. Yeah, sorry. What is
2.44.
2.444? That's right. So it comes to 2.444 is the value. So this is going to be 10 lakhs into 33%, that is 30,000 into the present value factor, 73320. Right. So at the first instance, what you need to tell the examiner, you need to basically identify and tell him that, okay, this is the fair value of the guarantee. So the entry will be investment in subsidiary gets a debit and the financial liability, which is the financial guarantee, gets a credit. So let me put the entry out here itself. Investment gets a debit, financial liability in the brackets, financial guarantee gets a credit, and this is to the extent of 73,320. Right, so the initial accounting stands identified. Now what we need to do in this particular case, I think I should ask you, what is going to be done at each balance sheet date? When you're going to measure this financial liability, we know that this financial liability is taken at FPTPL, but how would you decide that what is the change in the fair value of this guarantee at each balance sheet date? Your inputs. The silence again tells me that I'm supposed to answer that question now.
Yes, sir.
Okay, I got the answer.
We
So,
will charge interest at rate of 11% on 73320. Then we will deduct 30,000. Then we will get the closing figure. We will check whether closing figure or 1% of the given amount, whichever is higher, we'll consider that.
okay, that's wonderful indeed. Can you just elaborate what exactly are you doing? What is conceptually being done? You told me the mathematical computation, but what does this exactly mean?
Sir, we will take out the closing balance every year because in
What is that
market
closing balance? Is this the amortized cost of the financial
yes,
liability?
amortized cost only because we are
Wonderful indeed.
at 11%. That is market rate of interest on the benefit
Okay.
that we are getting.
Wonderful indeed. That's great. I think somebody has start giving good answers on that. So let's, I think, take it further. So I guess I'm just going to add this out here. Okay, so what do we need to do at the end of each year? So we're standing at the year end, that is 31st March X2. So we need to do the accounting for 2 years, X2 as well as X3. Now, in this particular case, what am I supposed to do when I'm accounting for the financial guarantee? We need to consider that what is the value of financial liability at amortized cost approach. That is one. And on the other extreme, we need to consider that if this liability gets triggered, then what will be the amount of, you can say, expected credit loss. So the standard requires you to visualize the two extremes. That one is calculate the amortized cost of the liability. And on the other hand, you need to consider that if this liability gets triggered, then what is the provision for expected credit loss. Now, naturally, if your liability is coming, let's say the book value is coming to, let's say, I'm assuming a figure, let's say it comes to 60,000. But if the liability gets triggered and there is an expected credit loss of 70,000, then there is a need to update the liability at a higher value of 70. So the standard says you need to consider the amortized cost. You need to consider that if a default occurs, the expected credit loss, take the greater of the two, and then compare the book value versus the greater of the two values, and any difference is going to be captured in the P&L because this guarantee is accounted at FVTPL. Let's see the calculations. So I think for ease of understanding, let's make a ledger account, because when you prepare a financial liability at AC, I think it's easy to make a ledger account, though you can make an amortization chart as well. But I always prefer to make a ledger account because I think the calculations becomes a little more easier to me, at least at this stage. So what was the amount of financial guarantee which we have calculated? I think 73,320, right? And let's now consider the finance charge at the rate of 12% on this. 11%. So let's consider 11%. Because you took the present value at the rate of 11%, so the same funda applicable, you did a discounting, and now we are doing the compounding, that is unwinding of discount. So 73,320, 11% would mean 8065 approximately. And what is the amount of benefits which is paid to the subsidiary? So the benefits which is paid to the subsidiary is, I think, to the extent of 30,000. How do I get the 30,000, which is a difference between 11 and 8%? So on the principal amount of 10 lakh rupees, 3% advantage is given to the subsidiary. So that is a benefit paid. So let's see what is the balance CD balancing figure. I guess 51385.
Yes, sir.
That's right. So this is one extreme calculations done. Now we also need to do the second calculation, that let's see what is the expected credit loss, because we need to consider the value of this financial guarantee at the higher of the two values. The value based on amortized cost approach, the value if there is going to be a trigger of a non-repayment. Now let's come back on the question and let's see that if there is a non-repayment, what happens? Now, in this case, it says on March X2, there is a 1% probability that default may occur in the next 12 months. So let's consider the concept of ECL. So this is going to be based on EAD. Can I say the principal amount of the loan itself is the exposure at default? Because when you consider a provision for ECL, there are three factors. The factor number one is the exposure at default, in which case it is the entire principal money of the loan, into the LGD, which is a loss given default. Now, I'm very clearly given that I will not be able to recover anything. It says that if Moon Limited does not repay the money, Sun Limited is not going to recover anything. So which means the loss given default in this particular case is 100%. Because I am exposed to 100% risk. If he doesn't pay, as a parent, I'm supposed to pay the entire money. So this 10 lakhs would be 100%, and the probability of default is supposed to be at the rate of 1%. So this works out at how much? 10 lakh into 1%? I guess 10,000. Does it work out, I guess, at 10,000, right?
Yes, sir.
Okay, so what do we need to do in this particular case? We need to consider the valuation at the higher of the two. So your financial liability is going to be recorded at this particular figure, which is the greater of the two. So basically, you need to sit down on the balance sheet date and visualize that if a default occurs, then what is the possible amount you'll have to pay? Because there is a 1% chance of making this payment, 99% chance of not making any payment. So indirectly, it is 10 lakh into 1% plus 0 into 99%. If you want to technically see the calculations on a weighted average basis. So if the default occurs, this is the amount payable and this is the liability value. So we need to update the liability. So my liability is financial guarantee standing at 73,320. You need to bring it down to 51,385. So let's see what is the difference in the financial liability calculations. That's, I think, 21935. So what is going to be the journal entry at this particular stage in order to update this value of financial liability? Because we are now bringing it down. So can I say this is a gain or a loss in terms of fair value? It's a gain. So financial liability, financial guarantee gets a debit and the gain is taken in the P&L. That's 21,935. So since this financial guarantee is going to be accounted at FPTPL, so any changes in the fair value of the guarantee, whether it goes up or goes down, is going to be captured in the profit and loss account. Okay, let's go further. Now let's look at the position for the year ended 31st March X3 as well. So here again, we're going to make a ledger account and consider an ECL aspect as well. So let me just make a ledger account for convenience. And then we can also compare this with the expected credit loss as well. So this is my financial liability that is at amortized cost. So the balance BD, CD becomes the balance BD, that is 51385. Let's consider the finance charge at the rate of 11% on this. So 51385 into 11%, I think it's 5652.
Yes, sir.
And then we do the entry for the benefits paid, that is 30,000. So you can get a balance CD as a balancing figure in this particular case. That's the amortized value. I think it's 27037, I guess. And similarly, we also need to now calculate that if there is an expected credit loss, then what is the default? I think the probability of default in that case is 3%, if I remember. So on the ECL, there is a 3% default probability that works out at 30,000. So we need to consider the greater of the two. So we consider the higher of the two. So that becomes the value of the financial guarantee, that is 30,000. So can I say now we again need to record the entry. This is now the book value of the financial guarantee in the books. And you need to bring it to 30,000. So gain or a loss in this case. Again, the liability value is coming down. So again, it's a gain. So can I say the same entry will be done with the difference? That is, I think, 21385. This is the amount of the entry at the end of March X3. Done. So this was two special cases. So I thought we missed the chain. So I just reminded you that as far as financial liabilities are concerned, 5 categories. So you've done the accounting for financial liability at AC. You've done the accounting for financial liability at PTPL. Now you're also done with a financial guarantee. Now, 2 liabilities which are there. One is in terms of contingent consideration that gets taken care in 103. And one is the concept of financial liability arising when financial asset is not eligible for derecognition will get taken care in the derecognition aspect. So rather, let me also document this part as well, so that the dots are connected. So we can say if you're looking at the types of financial liability, I think let's put it down as well. So that the chain is very clear at the back of the mind that when you're looking in terms of the different types of financial liability, what are the various kinds of liability? So there are total 5 kinds of financial liability. One is, you can say, the financial liability at AC, which is technically the default category unless mentioned otherwise. Then there is a fair value through profit and loss account, which is typically applicable if it is a derivative financial liability, or it is supposed to be held for trading, or if it is supposed to be designated, or if it is supposed to be designated to be measured, or if it is designated to be measured at fair value through profit and loss account. So that would be FPTPL. But today we've just added those 3 new elements as well, though I did not make a mention. So, but I thought I'll just document that part. So the 3 liabilities, one is on the financial guarantee, which is also captured at a fair value through P&L. And you now know that this financial guarantee, which is captured in a FPTPL, is supposed to be measured at the greater of the two, the amortized cost value, or you can say the provision required for ECL, whichever is greater. So this is measured at the higher of the two. It is supposed to be measured at, you can say, the amortized cost, or we can say the ECL provision required, whichever is greater. Then the other kind of liability is called the contingent consideration. This is the contingent consideration, and that contingent consideration arising out of 103, arising on Ind AS 103, that is business combination. So this will be covered later. When we come to 103, we'll cover this contingent consideration. But of course, to remind you, this contingent consideration is again valued at FPTPL. It's measured at a fair value through profit and loss. And finally, we can say that there is a financial liability which arises when derecognition of financial assets cannot take place. When derecognition of financial assets cannot take place. So this also we're going to cover in the derecognition section. So this also gets covered later. So I think that maps up the different permutation combinations of financial liability, the 5 broader categories in this case. So far, so good. So I thought early in the morning, let's do some practice with you. Extensive questions, 2 major questions done. Okay. So I think now we are ready on to go on to the next phase of discussion, the special issues. So now if you map your mind, accounting of financial liability, accounting of the compound financial instruments, accounting for the equity instruments, all done from the issuer point of view. And if you look at the accounting for the holder, that is financial assets, all the 5 categories done. The special issues when there is a difference in transaction fair value differences done. And the special issue within that special issue that there is a prepayment of a, you can say, loan also done. So the core accounting in terms of 109 and 32 gets done. Now the focus is on the 4 special agendas on the, rather I would say 3 majorly. One is the derecognition concept. One is the impairment concept. One is the hedging, and of course, the concept of embedded derivative. So now we're going to deal with all these 4 agenda one by one. So let's begin the journey on derecognition now. So let's go on to the concept of derecognition. So what do you want me, friends, to do in terms of derecognition? Give you some quick conceptual framework on the understanding and then proceed to the questions, or directly proceed to the questions? Your choice.
Sure, give some background, then we can go, sir.
Okay, perfect. So let's begin the input in terms of derecognition of financial assets. We'll first discuss the concept of derecognition of financial assets, and then we'll discuss the derecognition of financial liability. where the concept of extinguishment accounting and the concept of modification accounting applies. But first, let's focus on the derecognition of a financial asset. Now, lay me carefully. I'll just pen down the concepts as well. When you look at the concept of a derecognition, in simple words, it's a removal of asset from the balance sheet of the company. So when you're looking at the concept of removal of the financial asset from the books of accounts, Indus 109 has laid down a simple test which needs to be satisfied before a derecognition can happen. And for the ease of convenience, I have divided this again into a three-step model. Oh my God, again a three-step model. Everywhere in the standard, you've got three-step model. So in this particular case, we have divided the entire journey in terms of a three-step model. So let's first understand what are the three steps. So the derecognition would apply a simple three-step model, that is the principle. So there are two things which we need to understand on the derecognition aspect. Number one, you need to understand the principles which needs to be applied to decide whether a derecognition can take place or not. And if a derecognition takes place, is it going to be a full derecognition or is it going to be a partial derecognition? So basically, the standard gives you three kinds of accounting. That when you apply the principles in terms of derecognition, either you lead to the conclusion that it is a full derecognition, or you reach a conclusion that it is a partial derecognition, which is called a continuing involvement approach. Or it is a case where derecognition cannot take place. So you need to be clear on the first aspect, that what are the permutation combinations when you apply a full or a partial, or you can say no derecognition accounting. And then finally also understanding that how does this accounting take place? That if there is full derecognition or partial derecognition, or there is supposed to be, you can say, a continuing involvement, what is the accounting entries which are done? So as I'm going to proceed, I am going to give you a blended chart which will not only give you the principles of accounting, but also tell you the entries which are done under each permutation combination. So for this particular case, we have got a three-step model. So we begin with the step number one. So there are three tests, and these three steps is going to concentrate on each of these three tests. The first one is called a cash flow test. The second one is called a risk and a reward test. And the third one is called a control test. So when you're applying the principles of derecognition, you need to go the test number one called a cash flow test, the test number two, which is called a risk and reward, and the test number three, which is called a control test. So at the first step, we will apply the first test, that is called a cash flow test. Now, in terms of the cash flow test, what you need to basically identify, that is the cash flows arising out of the financial asset, is it supposed to be expired or is it supposed to be transferred? So basically, there are two elements to be seen, that is the cash flows expired or is the cash flows transferred, or you can say it is involving a concept what is called debt securitization. So I think let's not merge that concept of debt securitization. Let's concentrate on the two inputs. The cash flow test can be in two broader categories. So we will say, is the cash flow expired, or we will say the cash flows are transferred. So let's, I think, remind ourselves that when you say that the cash flows are expired or the cash flows are transferred, then what does this mean? Expiry of cash flow arises only when there is a full and final settlement. Let's say, for example, you sit down with a debtor and you tell him that, okay, you pay me a certain amount in full and final. That is called expiry of the cash flow. But if you say that there is a sale of the financial asset, if you say that there is a discounting of the bill of exchange, you are transferring the cash flows to the third party. So entering into a factoring arrangement with a factoring agency, discounting the bill of exchange with the bankers, these are all cases when the cash flows are transferred. So expiry would technically mean that you've gone in for a full and final settlement, F&F. That's what you call FNF, that there is a full and a final settlement in this case. That is called the cash flows have expired. If the cash flows have expired, in this particular case, we go for what is called a full derecognition. The derecognition can take place, and this is called a full derecognition. That means we are going to pass an entry. Let's say you are settling the money with a debtor, bank gets a debit, financial asset gets a credit, and any gain or loss is taken in the P&L account. So in this particular case, let's also pen down the entry as well. So the entry for derecognition would be, you put the entry, bank gets a debit. For the amount received on the full and final settlement, the financial asset gets a credit. And in this particular case, this is the credit at the book value. And this is with the amount which is received. The bank gets a debit with the amount received, and the financial asset gets a credit at the book value. And any difference in this entry, the balancing figure in this entry is taken as a profit and loss. Rather, I would say it can also be an OCI. Can I say if there is an equity investments, the gain could be in terms of entering OCI. But I think let's not get into that complication. Let's call it as a P&L to avoid any confusions at this stage. Though technically speaking, if there is supposed to be, because equity investments cannot get expired as such. Because equity investment is something which you can sell. And when you're making a sale of the investment, in those cases, it will enter into the trustworthy category. So I think let's put it like this, that if there is a full and final settlement, then there is an expiry of the cash flow, then any difference between the money collected and the book value enters into the P&L, gain or loss. Great. Now, if the cash flows are supposed to be transferred, the examples of cash flow transferred could be in terms of sale, but it has to be an unconditional sale. Or it could be in terms of, let's say, a bill receivable discounted. Or it could be in the sense that there is, let's say, entering into a factoring agreement. There is entering into a factoring arrangement. That is what we technically call a signing of trade receivable. This is the language which we call assigning the trade receivable to factoring agency. Assigning the trade receivables to a factoring agency or to the factoring company. So when you see languages in the question that it says that there has been a sale of the asset, there has been a discounting of a bill of exchange, or there is a assignment of a trade receivable to factoring agency, my mind immediately tells me that the cash flows are transferred in this case. And if the cash flows are transferred, then you need to go to the step number 2. I hope, friends, I'm clear with the step number 1. That is the cash flow test, correct?
Yes, sir.
Right, wonderful indeed. So we need to basically focus on the fact that is there a full and final settlement? Transferred results in a full derecognition. But if you say it is transferred, a sale of the asset, a factoring agency arrangement, whether it's recourse or non-recourse, it is transferred or it is discounting, because you are basically transferring the cash flows to another party. When you sell the financial asset, you're telling the other person that from today onwards, you get the cash flow. When you're entering into a factoring agency, you're telling them that you're going to get the cash flow. So it is a trust for the cash flow. It is not supposed to be that cash flows are now not going to come. It's not going to come to me, but it's going to come to the other party. Now, once the step number 1 is done, then you need to go to the second step. And the second step is conducting another test, which is called the risk and reward test. The second one is conducting, which is called the risk and the reward test. Now, the standard considers 3 possibilities, or you can say 3 permutation combinations when you're looking at a risk and reward test. Either the risk and reward is substantially transferred, or the risk and reward is substantially retained, or it could be a blended situation where the risk is neither substantially transferred nor it is substantially retained. So when you conduct the risk and reward test, there are 3 possibilities which can arise. So you need to make an assessment: is the risk substantially transferred to the other party? Then a full derecognition would take place. And if the risk and reward is substantially retained, then you need to continue the asset in the books of accounts. No derecognition can take place. But if it is a situation in between where the derecognition, where the risk and reward is neither substantially transferred nor substantially retained, then it becomes a case that you go to the step number 3 and conduct a control test. So the possibility when you conduct a risk and reward, we'll also see, when do you conclude that the risk and reward is substantially transferred or retained? We'll look at those cases as well. So for the time being, let's, I think, pinpoint that either it is substantially transferred, the word used in the standard is substantially transferred, or it is supposed to be substantially retained. It is supposed to be substantially retained, or it is supposed to be neither of the two. That means it's a mixed situation, neither substantially transferred nor it is substantially retained. Let's take a little input of a few examples, at least at this stage, when you can say the risk and reward is substantially transferred or not. Tell me one thing, if I go and discount a bill of exchange with a banker, I've transferred the cash flow. Then I come to the step number 2 of risk and reward. So let's say if the my debtor doesn't pay the bank, is the bank going to catch me? Are they going to say that your debtor is not paying, so are they going to catch me? Is that a recourse or a non-recourse?
Yeah, it's a recourse, sir.
That's right. So when you get a bill discount of the bankers very clearly say that if your customer doesn't pay, sir, we're going to come back to you. So which means the risk and reward is substantially retained. Let's take another case. You entered into a arrangement with a factoring agency where you assign your trade receivable to the factoring agency. They say that there is going to be a recourse. That means if the customer doesn't pay, they're going to catch me. The risk and reward is substantially retained again. But let's consider a situation where you enter into an factoring agency arrangement and they say that if your customer doesn't pay, don't worry, we're not going to come back to you. It is a non-recourse arrangement where the factoring agency will not catch me. Is the risk and reward transferred to the factoring agency in that case? Is it substantially transferred?
Yes, sir.
Yes. So we can say a few examples which can be correlated in terms of risk and reward transfer is, you can say a factoring arrangement. You can say that there is a factoring arrangement, recourse or non-recourse?
Non-recourse.
It is going to be non-recourse. That is correct. So this is one example where we can say the risk and reward is substantially transferred. And if you say it is substantially retained, I would say it is a factoring arrangement with recourse. So there is a factoring arrangement which is with a recourse. And even you can take the other example as well, where there is a bill receivable which is discounted. Because when you do the bill receivable discounting, then also the bank in this particular case can come back to you. What about a case of an unconditional sale? Is the risk and reward transferred or is it retained? I made a sale, unconditional in nature, no ifs and buts attached. Can I say risk and reward is again transferred if it is an unconditional sale in this particular case? Now, we also need to look at the examples when it is neither of the two, when it is supposed to be neither of the two. Now, this happens typically in examples, if you recall, when there is a sale and a repurchase agreement. This happens when there is a sale and a long call. And if there is a sale and a short put, I hope you remember those nitty-gritties which are covered detailed lectures as well, that there are cases when there is going to be a sale with a long call or there is a sale with a short put, and depending upon the situation that it is deeply in money or deeply out of money, or if it is supposed to be in and out money, then in those particular cases you could be in a fixed situation of neither. I hope, friends, you're able to recall those permutations and combinations, right?
Yes, sir. Option.
Wonderful. Great. So we can say the neither situations could be typically happening when there is a sale along with a long call option, or there is a sale with a short put options. And in which particular cases you cannot outrightly say that it is deeply in money or deeply out of money. So these are situations when they are in, at, or out of money. In those particular cases, it's like, you can't precisely decide that the risk and reward is substantially trustworthy or not. So just give you a few examples to clarify that when the risk and reward is trustworthy substantially, retained substantially, or it is neither. So let's see that in this particular case, which permutation of combinations would apply. Now, if I say that it is substantially trustworthy, I would be applying the concept of full derecognition. That means I'm going to do the similar entry which I did just away, that the bank gets a debit with the amount received, the financial asset gets a credit with a book value, and the difference is taken as gain or loss in the P&L. So in this particular case, the entry is the same. The bank gets a debit, which is with the amount received, and the financial asset gets a credit. This is with the book value. And any difference in this entry, the balancing figure in this entry is a gain or loss, which enters the profit and loss account. That is when the risk and reward is substantially trustworthy. Then comes the situation when it is substantially retained. In this particular case, there is no derecognition. There is no derecognition which can take place. Would you like to give me what would be the accounting treatment in this particular case? I think we just made a mention earlier when I was looking at the type of financial liability. So when there is a case when the risk and reward is substantially retained, you cannot go for derecognition. So am I supposed to record a financial liability? What do you say?
Yes, sir.
If
Financial.
that's right. So we are going to put the entry bank account debit and financial liability gets a credit. So in this particular case, the accounting entry which is going to be done in this case is you put the entry bank gets a debit and the financial liability gets a credit. This is the case when derecognition of financial asset cannot take place. So the amount received is recognized as a financial liability. So for example, if you discount a bill of exchange, can I say the risk and reward is trustworthy? And then if you look, the cash flows are trustworthy and the risk and reward is retained. So the entry for discounting the bill of exchange will be bank gets a debit and financial liability gets a credit. We are not going to remove the bill receivable from the books of accounts, what you traditionally do in school and college. And then comes the aspect, if it is neither, then it is time to go to the step number 3. Wow. So that takes care of the step number 2. I hope you're able to connect the dots in terms of the risk and reward test. That depending it is trustworthy, then derecognition is complete. And if it is retained, then creation of a financial liability. And if it is a blended situation, then you need to go to the control test in terms of step number 3. Let's now go to the step number 3. So in terms of the step number 3, the focus is now on the third test, and that is called the control test. And that is called the control test. Now, the control test is basically got only 2 permutation combinations. Either the control is trustworthy or the control is retained. There is no possibility of a blended one. Like the step number 2, either the control is trustworthy or the control is retained. If the control is trustworthy, then a partial derecognition will take place. It's not a case of a complete derecognition. It is a case of a partial derecognition. So what I'll do, after this, let's make a very interesting chart where you can see certain permutations of combinations and decide the kind of accounting which will apply. So I think after this, let's make a chart, before we'll do some practical questions on this. So in terms of the control test, we can say that there are 2 permutations combinations. Either it is trustworthy or the control is supposed to be retained. So if you say the control is trustworthy, this is a case of a partial derecognition. Would you like to give me a journal entry for this partial derecognition? What is the entry which I'm going to pass if there is a partial derecognition in this case? A mix of partial. Partial is mix of, full and no derecognition. Can anybody tell me the entry?
Bank account debit, assets credit and liability.
Which liability? Oh, you mean to say literally combine the entry? Aha, no. Okay.
Sir, we need to see the partial also, whether it look at the substantially transfer or substantially retained.
No, 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 no. In control test, we don't look at any substantial. The concept of substantial is restricted only to step number 2. In control, it is only 2 combination: transferred, retained. That's it. Now, let me, remind you in this particular case, the entry is, this is called a continuing involvement approach, CIA. It's called a continuing involvement approach because when it is a case of a partial derecognition, so the entry looks like this. The entry is bank gets a debit, the financial asset gets a credit, the profit and loss, if there is a gain, gets a credit, and you also put another entry as well, and that is CIA, a continuing involvement asset gets a debit and associated liability gets a credit, AL. So this is the combo entry. There is an illustration in the study material which gives you this combined entry as well. So in this case, what is happening when you record this continuing involvement asset and the associated liability, it is taking care of the partial derecognition. Because when you say full derecognition, it's a complete exit out of the asset from the balance sheet. When you say no derecognition, it's no exit of the asset to the balance sheet. Partial means the asset is gone partially. So first of all, when you put the entry financial asset gets a credit, it looks like a complete derecognition. But when you are recording a continuing involvement asset, that means it results in a partial derecognition in this case. And if you say the control is retained, then in that particular case, there is no derecognition. And if there is no derecognition in this particular case, we can say we are basically putting the entry bank gets a debit and the financial liability gets a credit in this particular case. Wow, my mind is now working on some inputs based on the permutation combination. Can I ask you some rapid fire questions at this stage? Say yes.
Yes, sir.
Great. So let me put some questions to you based on the 3-step model. So we've done that there is a cash flow test, there is a risk and reward test, and there is a control test. Now, quick questions to you. How many kinds of accountings are prescribed in terms of derecognition of financial assets? How many types of accountings are prescribed in terms of derecognition of financial assets based on this chart? Oh my God. My personal belief is I always remember, when we reach this stage of financial instruments, many people get very afraid at this stage. They remember the initial part of the standard. When it comes to impairment, hedging, derecognition, one suddenly feels, oh my God. Okay, let me,
Sir,
answer that question there. Yes.
Sir, 3, sir. One is full derecognition and no recognition, no derecognition, which means we will
Very
move
good.
to financial liability, and the partial derecognition, that CAI.
Very good. That's absolutely correct indeed. You can see clearly in the chart, which I said in that the inception as well, when you apply the principles of derecognition in terms of the 3-test approach prescribed in the standard, there are basically 3 kinds of accounting which one can reach. Either it is a case of a complete derecognition, or it is supposed to be a case of a no derecognition, in which case you'll end up recognizing a financial liability, or it is a case of a partial derecognition, which is called a continuing involvement approach. Next question. I'll give you a chain of sequence. You need to give me the kind of accounting which would apply. There is an unconditional sale of a financial asset. Just tell me the kind of accounting.
Yeah, full derecognition.
Wonderful indeed. Now, let's say there is a sale, but there is also a long call which is in money.
It is neither substantial transfer nor substantial retained.
So that
Mixed.
means you'll end up doing most probably a continuing involvement approach, right? Most
Yes, sir.
probably.
Yes, sir.
Correct. Okay, next question to you. Let's say I am considering that it is a sale with a long call which is deeply in money. There is a sale with a long call which is deeply in money. That means you're definitely going to exercise the long call in this case.
Maybe the partial derecognition.
No, 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 no. It is a case where the risk and reward is substantially retained, so that would lead to creation of financial liability. It's no derecognition. Okay, let's consider another one. If you say that it is supposed to be a sale with a short put which is deeply in money, it's a sale with a short put which is deeply in money. You made a sale and then the other person is going to basically sell you as well. It's a put option which the other person has decided he will definitely exercise. So he's going to sell the asset back to you. It's again the same case where there is a risk and reward substantially retained. In this case, again, it's a no derecognition. It's going to be a recognition in terms of things. I am getting a sense that many people are a little confused in terms of this long call, short put, etc. You want me to elaborate this?
Yes, sir. The option
am
is not
getting that feel.
option is not yet studied.
Okay. Okay. I've covered that in the detailed lectures, definitely. So please do watch that as well. But I think I'll just connect you to the dots. So let's, I think, understand this particular thing. Then I think we'll make a very interesting chart summarizing the various kind of accountings, because when you read a question and you look at the inputs, you should be able to correlate that, okay, this is how it is done. So let me, I think, just brief you, first of all, on the concept of a sale with a long call. Let's, I think, understand this carefully. Then we'll take sale with a short put. I hope I don't need to tell you that what is a long call. That means I've entered into an option that is to buy and which is supposed to be the right to buy. So when I say it's a long call, this is indicating that there is a right to buy. Correct? Now let's take an example. Please watch this carefully. You'll get the permutation combinations clear. Let's say there is A and let's say there is B. A made a sale to B. Did A receive the money? A made a sale to B. Did A receive the money? Yes, of course. A
Yes,
received
sir.
the money. Now, A also enters into a long call, which means he's got the option to buy the asset back from B, which means he's got the right to buy the asset back from me. So A gave the asset to B, and now he gets the right to buy the asset back from B. Now, please hear this carefully. If I say that this option is deeply in money, do you think A will buy the asset back from B? If it is deeply in money, do you think A will definitely exercise the call option? He is going to buy the asset back from B. Am I right?
Yes, sir.
Correct. So if he is going to buy the asset back from me, that means that A is basically taken, you can say, a loan from B, because he's never made a sale. He's not transferred the risk and reward. He says that you take this asset today, but since it is deeply in money, I'll definitely take the asset back. I hope you got the point. So in this case, we can say there will be no derecognition in this particular case. I hope
Yes,
I'm
sir.
clear with the thoughts.
Yes, sir. If it is a deeply out of money means, then he will not retain.
Yes. So when I say that it is deeply out of money, can I say in this particular case, A will never buy the asset back from B? He sold the asset to B. Now he'll say, thank you, bye-bye. I don't want to buy this asset back from you. So risk and reward is transferred. Can I say it will be a case of a full derecognition? Correct?
Yes, sir.
And now consider if the long option is supposed to be in money, or it is at money, or it is out of money. Can you with surety say that you will exercise if it is in money? Can you with surety say that you will not exercise if it is out of money? Can you with surety say that you will not exercise or exercise if it is at money? No. In this case, you can definitely say that the risk is substantially retained because I'm very sure of exercising the option. In this case, you can definitely say that the risk and reward is substantially transferred because you will definitely not exercise the option. But when it is in at out money, it is not a confirmed situation where you will say that no, I will not exercise or yes, I will exercise. So it's like a mixed kind of a situation, which becomes the risk and reward is neither transferred nor substantially. So you need to basically go to the control test and decide. Because if the control test tells you that you have transferred the decision making power, because I did not make a mention that when you consider a control test, you're looking at is the decision making power. That means whether the party will be able to make another third party sale or not. So is the decision making power gone to the other party, then you have transferred the control. But the decision making power is not there with the other party, then you have not transferred the control. So depending upon the position of control test, you decide the inputs. Yes, I think I can see Samya. I think you raised a hand.
Yes, sir. My question is that, say, in case of in money, in money also, that case it is a favorable for long call. Then definitely, yeah, it's good for him, no?
No, you see, but if it is deeply in money, you're very sure that it'll be exercised. But if it is in money, are you very sure or you're saying, maybe?
Yeah, it's an option of the.
Right. So which means if I say the option is deeply in money, I'm saying I'll definitely exercise. But if you say it is in money, I'll say, okay, most probably I'll exercise. So the question is when you're conducting a risk and reward test and you're saying that it is deeply in money, you're saying I will definitely in this case buy it back. So if you're saying you're definitely going to buy it back, risk and reward is not transferred, retained substantially. And if you say it is deeply out of money, you're saying undoubtedly I will not exercise. So if you're not going to exercise, then the risk and reward is substantially transferred in that case. But the moment it is in at out money, it's a dicey situation where you can't strongly say that you will exercise if it is in money. You cannot say that you will not exercise if it is out of money. You're saying, probably I may not exercise, probably I might exercise. So it becomes a situation where there is neither transferred nor retained. So you need to go to the control test to evaluate the further inputs in this case. Got my point?
Yes, sir. Got it, sir.
Great. Wonderful. Now, coming to the other part, and that is the other situation. If there is a sale, and there is a short put, what does a short put mean in this particular case? Can I say the short put would mean the right or the obligation?
Sale.
So it's an obligation because I don't have a long put. I don't have the right to sell, but I'm under obligation. The other party will say, I will sell it to you. And you'll say, okay, sir. So this is going to be, you can say, an obligation. Let's, I think, make the three combinations clear so that we connect the dots properly. So in this particular case, let's take the same example, A and B. Now, A made a sale to B. Let's say A made a sale to B and B enters into a put option where A is got a short put obligation and B is got a, you can say, long put where he's got a right to sell. Now remember, we are saying B has got a right to sell. So when B says, yes, I will say, A will say, okay. When B says, no, I will not sell, A will say, okay. So let's now consider the inputs, the permutations and combination. So let's consider this put option is deeply in money. What does this mean? Is B going to exercise the option? If this is deeply in money, is B going to exercise the option?
Yes, sir.
Yes. So that means A sold the asset. Now B is definitely going to, sell the asset back to A. So what do you think? Is it going to be a case of substantially transferred or retained? It is deeply in money. B says, I'll sell the asset back to you. So the asset comes back to me. So is A transferred the risk and reward or substantially retained?
Transferred.
It is substantially retained, so no derecognition would take place. So
Yes,
you'll
sir.
be landing up creating a financial liability, right? And you can see this as well. In this particular case, when it is deeply in money, it is exercising call. If it is deeply in money, it is exercising put. The conclusion is same. Derecognition will not take place because the risk and reward is substantially retained, not transferred. Now, what about a situation where it is deeply out of money? So what do you do in this particular case? Have you transferred the risk and rewards in this case?
Yeah, full derecognition.
Absolutely
Transferred.
correct. So there is going to be a full derecognition in this particular case. And if it is supposed to be in at out money, then what is the conclusion? Can I see you
Control
go to the
test.
control test again?
Control test.
Absolutely correct. So I guess I made the dots clear, though I was not supposed to make this particular revision, but I thought, since many of you are feeling that, what is this call put and all, I just did the revision to connect the dots clear.
Yes,
Okay,
sir.
wonderful indeed. So I'm still interested, making a small little summary chart to you that gives you a quick revision of the concept because we've seen those three tests with you. But I think looking at the inputs when there is a sale and if there is, let's say, bill receivable discounting, it is an unconditional sale with the call puts, etc., then what kind of accounting treatments will apply? Though we've seen that which step leads to which kind of treatment. But remember very carefully that there are basically in total three kinds of accounting for financial asset. Either it leads to a full derecognition, or it leads to a partial derecognition, which is called a continuing involvement approach, or it leads to no derecognition. So you've also seen the entries which are done in these permutation combinations, but you should be clear when you read a question. You should be clear that, okay, in this particular case, we are going to apply a full derecognition accounting, in this particular case a partial, because the language of the question should correlate that what kind of accounting are we going to apply. So we'll make a little small condensed chart, but I think let's first, I think perhaps give you a small break. I'm sure you need that one, and then we'll carry on the journey, because I want to do a practical illustration with you on the concept of derecognition of financial liabilities as well, where there is a concept of extinguishment accounting and the concept of what you call a modification accounting as well. Right, friends, so let's, I think, take a break for 10-12 minutes to the max, and then I join you back to start the journey. Enjoy a break. Thank you. So I think now let's make a small little quick summary chart, just putting these concepts together. And that would also help you to revise things at the end, just to give you a quick summary chart on certain permutation combinations, what kind of accounting would apply. There's not an exhaustive list of the chart, but just a quick summary of certain inputs put together. So let's make a small little summary chart to you. So I am looking at the derecognition of financial assets, in which particular cases, what kind of accounting treatments would apply. So I'm going to put some questions to you. Just apply the concepts, what we have just revised, and tell me the kind of accounting applicable. So we know that there are a total of 3 tests. So I'm making a column for particulars, then the step number 1, the step number 2, the step number 3, and that will decide the kind of accounting. So particulars, I'm looking at step 1, that is my cash flow test. Step 2, that is my risk and reward test. Step number 3, that is my control test, and that would decide the kind of accounting which would apply. So let's begin with some simple combinations to begin with and help me out. There is a full and final settlement. There is a full and final settlement, cash flow transferred or expired.
Full derecognition.
Right, so but cash flow expired or transferred?
Cash flow expired.
Wonderful. So can I say I don't need to apply the step in 2 and 3? It's going to be a full derecognition. So can I put the entry financial asset gets a credit, bank gets a debit, financial asset gets a credit, balancing figure gain loss, profit and loss, done. Great.
Yes.
Next, let's consider a case of unconditional sale. Cash flows expired or cash flow transferred? It's an unconditional sale. That's right, it is transferred. And what do you think? Risk and reward substantially transferred or substantially retained?
Transferred.
Substantially
That's
transferred.
right, substantially transferred. No need for the step number 3. Can I say again a full derecognition would take place? Right, let's take another permutation combination. Let's say there is a bill receivable which is discounted. There is a bill receivable which is discounted. Cash flow expired or transferred? Transferred again. And what about the risk and reward? Substantially transferred or substantially retained?
Okay.
Bill is always with a recourse.
Retained.
That's right, it is substantially retained. So give me the accounting.
No derecognition. It's a
That's
financial
right,
liability.
no derecognition. So creating a financial liability in this particular case. Bank gets a debit and financial liability gets a credit. So whatever amount is collected, you recognize a financial liability in that case. Great. Let's look at the other combination. So now I am looking at sale with a long call, or I'm looking at a sale with a short put. It's one and the same thing. So sale with a long call or sale with a short put, and I'm looking at 3 permutations combination. It is deeply in money. It is deeply out of money, or it is in at out of money. Let's first of all talk about the cash flow. Is it expired or transferred in all the cases?
Transferred.
It
Transferred.
is transferred. Wonderful indeed. What about a deeply in money? Substantially transferred or substantially retained?
Retained.
Wonderful indeed. And it is substantially retained, then what kind of accounting would apply?
Financial liability. No
That's right,
derecognition.
no derecognition with a financial liability is going to be getting recognized. Great. And if it is deeply out of money, then what about the risk and reward?
It's transferred, substantially
Yes,
transferred.
substantially transferred. So what would be the accounting in this case? Full derecognition?
Full derecognition.
Wonderful indeed. So let me also make a statement interim in between before I go to the last situation, and you can vouch me. Can I say till you are in step number 1 and 2, you don't enter the step 3, a partial derecognition cannot apply. Am I right?
Yes, sir.
That's right, absolutely. Because it is only when you enter the control test that a partial derecognition accounting gets triggered. But if you are within the cash flow test and within the risk and reward test, then in that case, either it is a full derecognition or there is no derecognition. The concept of partial derecognition only touches upon when you go to the step number 3, that is the control test. Okay, let's look at the last one now. In at out money. What do you say? Risk and reward transferred, retained, neither.
Neither. We need to go to control
That's
test.
right. So you need to apply the control test, and the control test will decide the fate on which kind of accounting would apply. So that's a summary chart in terms of deciding the derecognition of financial assets in this case. Wow, so far so good. So I think that is conceptually done. Okay, now I think it's time to take you to the derecognition of financial liability. So I'll do a quick revision, but then I'm interested in doing question. Today, the focus is more on doing questions with you. We've done already questions early in terms of the special case of partial repayments, in terms of the financial guarantee accounting. Now the focus is also going to be on the financial liability derecognition accounting. But I think let's first take a little recap of the concept and then do a question with you on that area. So let's now discuss the concept of derecognition of financial liability. So watch this carefully. I'm just going to first take a quick recap on the concept and then start doing a question with you on this area. So what I've again done in terms of derecognition is translated the accounting in terms of a 3-step model. Now, one needs to be very careful because this is one focus point which you need very clear. As part of the derecognition of financial liability, there are 2 aspects. One is deciding the kind of accounting to be applied. Because you need to apply a 10% test, and the 10% test will decide either you're going to apply an extinguishment accounting or you're going to apply a modification accounting. The second stage is how the modification or the extinguishment accounting takes place. So when you look at a particular question, your focus needs to be very clear in the mind that you need to attack the questions in 2 parts. At the first instance, you need to decide the kind of accounting which would apply, which is applying a 10% test and reaching a conclusion on the kind of accounting to be applied. And the second is, once you reach the conclusion, how does a modification or how does an extinguishment accounting apply? So let's divide our concept in terms of 2 parts, the revision chart in terms of 2 parts. So I'm just giving you a quick summary chart, deciding the kind of accounting and how does that particular accounting apply in both the cases. So one is the concept of a 10% test. And one is the concept of accounting to be applied once you've applied the 10% test. So let's first of all consider that what you're going to do in the 10% test. Now, there are some small nitty-gritties which should be very clear in your mind as you progress. Now, in terms of the 10% test, we are going to apply again a 3-step model. So in the first step, when you're applying a 10% test, you need to consider the present value of original cash flows. So what do you need to do in step number 1? You need to consider the present value of the originally decided cash flow. So if I've taken a loan from the bank, I need to consider that, okay, what is the present value of my original cash flow? And of course, when I'm considering the original cash flows, then in this particular case, I'm considering whatever is the remaining cash flows at that stage. The question arises when you consider the present value, would you like to tell me that this present value will consider which discount rate? Because when you're looking at this 10% test, it is like renegotiating with the bank and telling them that, okay, let's make a modifications in the terms of the loan. So when you're going to consider the present value of the remaining cash flows originally decided, which present value discount rate are you going to consider? I think I need to answer that as well. It is original EIR. It is the original effective interest rate which was decided on that loan liability initially. Then we go on to the step number 2. And in terms of the step number 2, you need to consider the present value of, you can say, the new cash flows in this particular case. Remember, this is original and this is new cash flow. This is also the remaining cash flow. You've renegotiated with the bankers, and in this particular case, we need the present value of the new negotiated cash flows. And what is the discount rate to be taken to calculate the present value? I think let me answer that again. So this is again going to be considered based on the original EIR itself. So please remember the key focus points. When you're considering the step 1, you're considering the discount rate original EIR. When you're considering the step 2, you're again considering the original EIR. So discounting rate in the 10% test is always the original EIR. The focus in terms of step 1 is the original cash flows, the remaining original cash flow. And the step number 2, the focus is the new negotiated cash flow. Another important input which you need to keep in mind when you consider the present value of these cash flows, please also remember that if there is any transaction cost, please add that as well. There might have been some cost which is incurred in terms of renegotiating the loan. So when you're considering the step number 2, this is one crucial point when people forget that you need to consider the cash flows, all the cash flows, including the transaction cost incurred, if any. And then we go on to the step number 3. In terms of the step number 3, so what are we going to do? We're going to consider the difference between the step number 2 and 1. And then you're going to express this as a percentage of step number 1. The difference between the present value in step 2 and 1 over the percentage of step number 1. And when you consider the present value in this particular case, you get a percentage. And when you get this percentage, you need to be careful on the percentage. Can I say if this percentage is 10% or more, would you like to tell me which accounting would apply? If this percentage works out at 10% or more than 10%, the variation is 10 or more than 10, which kind of accounting would apply?
Extinguishment.
Very good. So we're going to apply the extinguishment accounting in this particular case. And if we say that it is below 10, I did not say 10. The 10 percentage is out here. If it is below 10 percentage, then we apply the concept of modification accounting. So the 10% test will decide the fate of what kind of accounting is to be applied. So once you reach a 10% test, it's more like a materiality test in terms of the variations in cash flow. If your percentage is 10% or more than 10, extinguishment, otherwise modification. So what do you do in terms of extinguishment accounting? So what we're going to do in this particular case, the old financial liability will be derecognized at a book value. If it is extinguishment accounting, you need to derecognize the old financial liability from the books of accounts, and you need to recognize the new financial liability in the books of accounts, and that is at a fair value. Now remember, be cautious at this particular stage. When you consider the fair value, please do not pick up the information from the step number 2 of the 10% test. I repeat. When you're considering the fair value, don't pick up the information from the step number 2. That is using an original EIR. Now, when you're considering the fair value in this case, you need to consider the present value of new cash flows. So the focus point is we need new cash flow, and the present value is going to be taken on the basis of new effective interest rate. We're going to consider the new EIR in this particular case. So remember, you need to take the remaining cash flow as per the new terms, and you need to consider the discounting at new EIR. And remember, please do not take a TC. In terms of extinguishment accounting, the TC is immediately expensed off. It is not adjusted in the financial liability figure. So remember, the TC is taken in the 10% test calculation, but the TC is not taken when you consider the fair value. So there will definitely be a difference in this entry. So this difference in this entry, the balancing figure is again a loss to be taken in the profit and loss account. And apart from this, any transaction cost which is incurred, this is going to be debited to the profit and loss account immediately. So whatever transaction cost is incurred is going to be debited in the profit and loss at immediate level. So this is how the extinguishment accounting would apply, derecognizing the old liability at a book value, recognizing a new liability at a fair value, and any balancing figure gain or loss is captured in the P&L. Now come that if there is a modification accounting, what am I supposed to do? Simple accounting in this particular case, I will only capture the transaction cost. Whatever transaction cost is paid, the financial liability will be debited. The financial liability will be debited. So in this case, the transaction cost incurred on the renegotiation will get adjusted in the financial liability. And once you do this, then there is a need to calculate, there is a need to compute the new EIR for subsequent accounting purposes. Because the moment you reduce the financial liability by the amount of TC, in that particular case, you need a new EIR for the subsequent accounting. Let me just consolidate the picture. That was a quick summary chart in terms of deciding the derecognition of financial liability. I'm making these charts so that you get your quick revisions at the end. You can even add on a few things in this charts based on your revisions, based on the doing of the questions. Please add on some elements in this and make your own mind maps as well. So moral of the story, when you're considering a derecognition of a financial liability, in terms of derecognition, remember there are two stages in which you proceed. The stage number one is you need to conduct a 10% test to decide the kind of accounting applicable. And then the stage number two is once you've decided the kind of accounting, then you do the extinguishment or the modification accounting as the case may be. Let me put some rapid fire questions based on the learnings. Let's get the answer before we do a practical illustration with you. When you conduct a 10% test, is there a role of a new EIR? When you're conducting a 10% test, is there a role of a new EIR? That's right, no.
No, sir.
We do not consider the new EIR. Okay, when you're considering a 10% test, do you consider in step 2 the TC is added?
Yes, sir. We
Yes,
will add the TC.
Yes.
When you reach the extinguishment accounting, is the TC adjusted to the new financial liability?
No, charge to P&L.
No. And the calculation of the new liability is based on original or new EIR?
New EIR.
It's based on the new EIR. And when you consider the modification accounting, can I say the TC gets adjusted, but in terms of extinguishment, it is expensed. And therefore, this leads to the calculation of the new effective interest rate as well.
Yes,
I hope
sir.
that captures the concept in a summation form.
Yes, sir.
That's
Clear,
good.
sir.
Great, wonderful indeed. Now, I think let's take it further. I am now going to take you to more questions. I think let's have a look on question number 15. I think since the heading is already given, you know that it is extinguishment accounting. But technically speaking, we'll apply a 10% test and decide whether extinguishment accounting applies or not. So let's begin the journey. It says on 1st January 2020, A issues a 10-year bond for 10 lakh, bearing an interest at the rate of 10%, which is payable annually at the end of each year. The bonds are redeemable on December 29. That makes it a total of 10 years. There is no cost of fees which is incurred. Can I say no cost is a reference to TC?
Yes, sir.
And fees is a reference to processing fee?
Yes, sir.
So can I outrightly say that the contracted rate and the EIR is same?
Yes,
If there
sir.
is no TC, if there's no processing fee, no discount, no premium, EIR contracted rate is same. Great. So the effective rate is 10% already given. The contracted rate is also 10 and the interest rate is also 10. That also tells me that there is no off-market transactions in this particular case as well.
Yes, sir.
Then he says on January 25, that is after 5 years, ABC and the bondholders agree to a modification in accordance with which the terms are extended to 31, another 2 years. So can you tell me what is the remaining period of the loan? We renegotiated after the end of 5 years and the loan is extended for another 2 years. So now what is the remaining tenure of the loan?
7 years.
That's right, absolutely. Then he says the interest is reduced to 5% instead of 10 and the bonds are redeemable not at 10 lakh but at 15 lakh rupee. The legal and other fees is also given, that's the TC. A determines that the market rate of interest on January 25, the date of modification, is 11%. That becomes my new EIR. The repayment schedule of the original debt is given to me. So I'm given how the original debt is to be repaid. So we are given the inputs on this. Is this visible, I guess? Though we don't need it much actually. So these are just the flows. I'm just required to suggest the appropriate treatment. So I think that chart is technically not required because you're making a repayment of the principal, which is 1 lakh rupees each year. So, I mean, that's, sorry, the interest payment, not the principal. There is only a payment of the interest every year. The principal is a bullet repayment in this case. Okay. So I think the question is mainly contained to this part. The remaining, I think one can compute it on its own as well, because you are making a payment of interest at the rate of 10% each year. Now, since there is a modification, or you can say a renegotiation with the bankers and the company, there is a need to make a 10% test to decide the kind of accounting. So I think let me just add the question here itself. So this is, I'll give the question number reference. It is question number 15. So we're looking at the question number 15. So what I'm going to do, first of all, apply a 10% test to get the results. Now, let me go step by step and you can help me out with how the calculations will proceed in this particular case. So my 10% test is going to be based on a 3-step model which I gave you. So let's begin with the step number 1. Can I say I am supposed to calculate the present value of original cash flows, and that is, of course, the remaining cash flow. So there are 2 focus points. Just to remind you back again, when you're going to consider the present value, which discount rate are you going to consider?
Original EAR.
That's right. That is 10%. So we need original EIR. That is at the rate of 10%. And the second focus point is that you need the remaining cash flow. Can I outrightly take it as 10 lakh? The loan is for 10 lakh rupees. You're making a repayment of 1 lakh as interest every year. Can I say at the end of 5th year, if you consider the present value of the remaining cash flow, can I undoubtedly say it'll be equal to the book value, 100% guaranteed? Agreed?
Yes, sir.
Or do you want me to prove this to you? I can prove it as well. If you want, let's prove it. So what is the interest to be paid for the next 5 years? Can I say 1 lakh is the interest to be paid for the next 5 years? Give me the cumulative factor at 10% 5 years. PVIFA at the rate of 10% for the next 5 years. I think 3.791. So you're going to
Yes,
pay this 1 lakh rupee interest for the next 5 years. And then you're
sir.
also going to pay the principal of 10 lakh rupees. Can I say we need a PVIF at the rate of 10%, 5th year end? I think that's 0.6 to 1, is it? Yes, it's 0.6 to 1. So this is based on the original terms, whatever is the remaining cash flow. So I've taken the interest payable for the next 5 years and the principal payable at the end of another 5 years, discounted at the original year. Let's see, are we getting the same figure?
10 lakh 100 we are getting, sir.
So almost 10 lakhs, I would say, just 100 rupees difference, decimal places, right? So as I said, in this particular case, since there is no TC, there is no processing fee, I think it's a very simple case, because if you borrowed money at 10% and you discount the future cash flows at the same 10%, so you pay 10, you discount at 10. So if you're compounding at 10, discounting at 10, you will definitely reach the same answer. So this gives me the present value of the remaining cash flows originally. Then we go on to the step number 2, and we need to consider the present value of new cash flows. So we need to consider the present value of the new cash flows in this case. And again, we've got the focus point that when you consider the present value, which EIR are you considering?
Originally, yeah, that is 10 percentage.
That's right. So again, we are considering an original EIR that is supposed to be 10%. And when you're considering the new cash flows, again, the focus point is to consider the remaining cash flow. And there is another third focus point as well. What is it?
If it is a transaction cost, then we need to include it.
That's right. So TC, so there was a cost which was incurred, I guess. So the cost which is incurred is to the extent of, I am given, there is a legal fees of 1 lakh rupee which is incurred. So also take that 1 lakh rupee which is TC. So you need to be very careful on the crucial inputs. Step number 1, there are 2 focus points. Discount rate is original, and we need to consider the cash flows which is supposed to be based on the original terms. And then in the third step, we got 3 focus points. Discount rate is original, remaining cash flows, and TC. So let's do the calculations.
Yeah, and also we could see the redemption on premium.
Yes, that would also be taken into account. So let's consider the modified cash flows. So my renegotiations are done, and I am now paying interest at the rate of 5% for the next 7 years. And I'm going to pay 15 lakhs at the end of 7th year. So we are supposed to pay interest at 5% on 10 lakh. So earlier it was 10%. Now we've negotiated at 5%. So we need the PVIFA that is at the rate of 10% for a period of 7 years. 1, 2, 3, 4, 5, 6.
It's 4.868.
8. Correct. 4.868. And then you also consider the principal of 15 lakhs, which is PVIF at the rate of 10%, 7th year end. And least we forget, let's also take that legal fees that is payable right now. So no discounting required. So 0.513 is it? 7th year factor. So that takes care of the interest and the principal and the transaction cost. Let's see the sum total of all this. So this is 4.868 into 50, 243,400.
Together total 11 lakhs 12,900.
Correct, that's right. 11,12,900 is the total. Great. So step one is done, step two is done. We are on the 10% test. Now you need to get the variation between the step two and one expressed as a percentage of step one. So let's go to the step number 3. So let's see the variation in terms of percentage. So step number 2 is 11,12,900 minus 10 lakhs taken as a percentage of 10 lakh. So let's see what is the percentage of variation. It's basically more or less you can say a materiality test which we are applying.
11.29 percentage.
Wonderful indeed. So 11.29% is the variation. And based on 11.29%, can I say which kind of accounting would apply?
Extinguishment method.
Extinguishment accounting, that's right. So once you reach the area that what kind of accounting is applicable, then I think it's easy to apply the kind of accounting. Trust me, systematically is what you need to go. Go step by step. That's the reason, in all these standards, what I've done, I've created step-by-step models so that, everybody can proceed in a very chronological order. And that makes us, more like a machine learning. That makes us more like, robots, artificial intelligence who can think on those lines. Okay, so this is done. Now let's do the accounting.
Accounting in AI model.
Yes, AI is, of course, there are two things which I see is very prominent these days. One is AI and one is sustainability. Okay, so let's now consider the extinguishment accounting. So let's consider the extinguishment accounting. So now we need to be careful. Let's first make the journal entry and then we'll put in the amounts as well. So in terms of the journal entry, first of all, we consider the financial liability, that is old financial liability, gets a debit. And what will be the value at which it gets a debit?
10 lakh.
That's right, the book value. And we record the financial liability, that is the new one, at a credit, which is fair value. And this fair value is supposed to be calculated using original or new EIR.
New EIR.
That's right. So that's, I think, at the rate of 11%. Yes. So we're going to consider the calculation of the fair value. So 50,000 is the interest to be paid, PVIFA, at the rate of 11% for 7 years. So we need to pay the interest for 7 years. And we also need to pay the principal of 15 lakhs, which is PVIF at the rate of 11%, 7th year end. And what about the TC? To be taken or not to be taken?
Not to be taken, sir.
Not to be taken. That would be expensed off. So let's see what is the fair value. So present value factor 11%. 1, 2, 3, 4, 5, 6, 7. This is 4.712.
Yes, sir. 4.712. On the 7th year, 0.4817.
That's right, 482 to 3
482.
decimals.
Yes, sir.
So 50,000 into 4.712, 235,600, 958,600. That works out at 958,600 is the fair value of this liability, I guess.
Yes, sir. 9,58,600. Yes.
That's right. So we get a balancing figure on the credit side. And where do we put the balancing figure on the credit side? Profit and loss. That becomes a gain on the extinguishment of the liability. So that is 41,400. So that works out at 41,400 is the P&L. And one more entry needs to be done as well. And that is the initial legal fees, the TC, which is expensed off. So we're going to put the entry profit and loss. That is the transaction cost gets a debit and the bank gets a credit. And this is to the extent of 1 lakh rupee, the initial fee which is paid. Wow. So I think that takes care of the extinguishment accounting when we reach a 10% test, which is 10 or more than 10. Let's, I think, do another question as well on the modification accounting in this particular case. Okay, so we've got, I think, a little dreaded question on that. Okay, so this is a December 21 examination question. I think maybe I can zoom it further.
Yes, sir, it's not clear. It's not visible that much.
Yeah, no problems. I think I'll just zoom it. This will work good. Or let me just, I think, crop it first.
I think the derecognition aspect, the financial liability is more tricky than FEA.
The remaining section of the standard is a little tricky, of course. I generally see that students generally, leave these portions considering the frequencies in the exam. And they say, let's not do this area. I think now it should be clearly visible, I guess.
Sorry, anyway, after clearing the CA, we need to be in practice or working. We need to understand these things.
Undoubtedly, because you see, I personally believe that people should always study with a knowledge perspective. If one is going to study only from the point of view of examination, then I think you don't become a good chartered accountant in that case. Knowledge is very essential because passing exam is one particular thing, but being in practice, being a professional, your knowledge has to be very, very thorough indeed. So I think to that extent, yes. If you study on a knowledge levels, passing exams is never a difficult thing. I think passing exam is automatically taken care if you study with a concept. That's my belief.
Yes, sir. Without studying financial instrument also, we can clear the exam.
I think so. I don't know. Okay, let me, I think, just take you now to this particular question. This is an examination question. Just a second. Okay, so let's have a look at the read on this particular question. So I am given, it says Cooper borrowed 95 lakhs as a loan from XYZ Bank on 1st April 18 at an interest rate of 10%. Then it spent the loan processing charges. My mind is thinking, there is a processing fee. What does it lead to?
EAR.
Wonderful indeed. The moment you see that there is any processing fee, any transaction, whatever, it leads to an EIR. So the interest is given 10%, but this will definitely lead to a EIR. The principal amount of the loan is repaid in 5 equal installments and the interest is paid annually on accrual basis. So we're making the interest payment at the end of each year and the principal also at the end of each year. And he's already given you the effective interest rate as well. Then he says on 31st March 20, which is another 2 years, Cooper faces challenges in business because of a sudden change in technology. It approached XYZ Bank and renegotiated the terms of the loan. The interest rate is changed to 15% and the principal amount is repaid in 8 equal installments starting from 31st March 21. And the interest is paid annually on accrual basis. Before approaching the bank, Cooper made the interest payment on 31st March 2020. You're required to record the journal entries in Cooper till March 31, 21 after giving effect to the changes in terms of the loans on 31st March 2020. Then he says working should form part of your answer. So I think this is clear-cut case of renegotiations with the bank. Since you've renegotiated with the bank, can I say this needs to be evaluated on the basis of 10% test that is there a material change or not? Are we applying an extinguishment accounting or are we applying a modification accounting? So let's proceed. So I think let's first of all conduct a 10% test in this particular case. So the question is now simple. Can you consider in step number 1 the book value of the loan to be the present value of the future cash flows, remaining cash flows at original EIR? Will I be able to consider 95 lakhs? Yes or no?
Yes, sir.
No. In the previous question, there was no TC, no processing fee. So book value was equal to the principal amount of the loan. But in this case, the principal amount of the loan and the book value of the loan would not remain the same. On 31st March 2020, you need to first make a ledger account because 95 lakhs would be reduced by the processing fees and then you would have done the ledger account. I hope you got my point.
Yes,
That's the
sir.
reason I'm doing this question.
We have processing fee. Correct.
Correct. So let's begin with the step number one. So before we begin with the step number one, I think let me organize my financial liability ledger, which of course is going to be made at amortized cost approach. So I think the first thing before we even apply the three-step model, I would say before you even apply the three-step model is organizing the book value of the financial liability at 31st March 20. So which means we need to make a ledger account for a period of 2 years. So tell me what is the amount of liability which will be initially captured? $95 lakhs or minus the processing fee? Minus the processing fee, that is 180,912. So this is the initial recognition of the financial liability the day the loan is taken. Let's see how much is that. 95 lakhs minus 180,912. This is, I think, 93,19088. We calculate the finance charge. So what is the rate at which you will take the finance charge?
10.8.
That's right, EIR. So let's take the interest at the rate of 10.8% effective interest rate. 100,6462. And then we make a payment at the end of the year. So tell me what is the payment which is made. We're making a principal repayment in 5 equal installments and the interest is also paid annually. So can I say we would pay 95 in 5 equal installments? That comes to 19 lakhs. Plus
Yes,
we'll
sir.
also pay a 10% interest. Can I say 9 lakh 50? That would be on the face value of the loan.
Yes, sir.
So we get a balance CD as a balancing figure. So this question takes us a little step further because of the transaction cost given in the question. We had to do one little extra step before the three-step model. So this is 93,19088, 100,6462 minus 28 lakh 50. I think it is coming to 74,75550. Just see if this is correct.
Yes, sir.
Right. So then we can proceed further and take this as a balance BD in the next year. So that is 747,550. Again, let's consider the finance charge at 10.8% on this money. That's, I think, 807,359. And then again, how much payment is made now? We're sitting in the year ended 2020. He says the Coupa company faced a challenges, approached the bank for renegotiation of the loan. The money is now paid in 8 equal installments. And it says before approaching, he made the interest payment. So do I consider only the interest payment or do I consider the principal repayment as well?
Only interest payment.
Correct. So my principal money, can I say, would be 95 minus 19. The principal outstanding would have been 76 lakhs, on which you would consider a 10% interest. That is 7 lakh 60. Right. So this is the status of the liability as on 31st March 2020. So we can take the balance CD as a balancing figure. 747,550. 807,359, 760. I think this is coming to 75,22,909. correct? I hope the calculations are correct in this case. So
Yes, sir.
this we have calculated for the purpose of calculating what is the book value of the financial liability, because we also need this later. Okay. Now let's proceed with the inputs. Now let's go to the step number 1. Let's conduct the 10% test. So in terms of the 10% test, we need to consider, can I say in step number 1, the present value of original cash flows. We need to consider the present value of the original cash flows. So can I say the
Remaining
present value of original cash flows is based on the payment of the 10% every year and the principal repayments. So I think I'll have to create a schedule for this. How many more years of payments are pending?
3 more years, sir. 2
3
years.
more years to go. That's right. So we've got 3 more years to go. So we can say second, third, fourth, and fifth. Why I've taken second? Because one principal repayment is pending.
Yeah, only interest paid.
Yes, only the interest is paid. So let's take the cash flows and let's take the discounting at 10.8%. And we get the present value in this case. So a chart will be prepared for the other part as well. Okay, so let's take the cash flow. This was, I think, how much? 19 lakhs, I guess. Because
Yes,
5
sir.
equal installments,
Yeah,
19.
principal is 19 lakhs.
So principal is continuously 19. Can you give me the interest in this case?
On second year, we paid the interest.
Yes, second year we paid the interest. So the outstanding principal, I guess, was standing at 76. So I guess it should be 760 only, right?
I think we can refer the previous working. We have
Yes,
mentioned it.
that's what. So I think the interest was coming to 760 in the second year. But since we did not pay the principal money, that means my outstanding money is still 76 lakh. But okay, but I think based on the original cash flows, let me just come back on this. It says the principal amount now will be paid in 8 equal installments, that's right. So it says Cooper made the interest payment on March 2020. Okay, so I think it's given I paid the interest payment, but I think I remember that, in the solution, they've made a payment of the principal interest both. Otherwise, this can lead to complication. So I am also considering that though it is given interest is paid, I'm assuming principal interest both is paid. So I think let's not consider the second year column. Let's consider only 3 years. So let's take the interest. Can I just reduce the interest also 1/5 every year? 760 reduced by 1/5. I think the interest is 6,08,000. So this was 9,50,000, 1/5. We need to reduce 190. Sorry, I think it's not 608. My interest in the first year was 9,50,000. Keep reducing it with 1/5. So 950 minus 190. That was 760 minus 190. This is 570. This is 380. And this is 190. I've just taken 1/5 reduction out of the first year interest. My first year interest was 95 lakhs at the rate of 10%. That's 9 lakh 50. Keep reducing it by 1/5. We get the figures. So this is the interest for the next 3 years to go. Let's see what is the discounting factor. 10.8%, 0.903, 0.815, 0.735. Let's see the present value of all this. It's a lot of calculations indeed. So this, I guess, works out at 2230,410. That's, I think, 1858 200.
200.
That's right. And this is 1536, 150. So present value of original cash flow discounted at the original rate. Let's
So
add this up.
total 80 lakhs 94 760.
I think it's coming to 56, 24, 760.
One minute, sir. Okay, it's my mistake, sir.
Okay. So just see, it is 56, 24, 760. Yes.
Yeah, this is
It is
correct
56,
one.
24, 760.
Sir,
Correct.
I made a mistake. Instead of totaling GT, I put equal. That's my fault.
Okay. Okay. No problem. Okay. So this is my step number 1. I now need to go to the step number 2 as well. Steps are the same, except that a lot of calculations to be done. Now we need the present value of the new cash flows, again based on the original EIR itself. Now, since they've renegotiated, the principal money is paid in 8 equal installments. Oh my God. Now we got another chart for a period of 8 installments. Oh. So year 1, 2, 3, 4, 5, 6, 7, 8. So I think we paid out of 95 lakhs 2 installments. That is 19 lakhs each. So what is the total principal which is pending? Can I say 57 lakhs? Out of 95 lakhs, you paid 2 installments of 19 lakhs each. Now, because of the renegotiation, you're supposed to pay the balance in 8 equal installments. The principal amount is repaid in 8 equal installments on March 21. So see, if this is paid in 8 installments, how much would this become to? I think 7.125 lakhs, right? So this is the principal repayment for the remaining outstanding loan which is paid. So let me just take the cash flows which are going to be paid. So the principal is going to be paid 712,500. It's common to all. I'm just putting it like this. And as far as the interest is concerned, what is the new interest rate? I guess the new negotiated rate of interest is given at the rate of 15%. So let's consider 15% on the outstanding loan. So can I say on 57 lakhs, you take a 15%, it comes to 855, is it? I guess 855, right? So can I keep reducing this by 1/8 every year? Yes, of course. So that works out at 748, 125. 106, 875. This is 641, 250. I'll just note the figure. This is 106, 875. So I'm reducing the interest by 106, 875 every year. That is 534, 375. This is 427, 500. That is 320, 625. That is 213750. And this is 106875. Oh, so this is the 8 installments, 8 equal principal installments, and accordingly taken the interest. Now, this is to be discounted at what rate? Again at 10.8% to get the present value. Okay, so more calculations to go, but we are almost, I think, done with the calculations, I guess.
Yes,
So,
sir.
12 marks, a lot of computations indeed.
For this 14
Okay.
mark may be given.
Yes, it's quite a lot. So this is 0.903, 0.815, 735, 664, 599, 541, 488, and 0.440. So let's calculate the present value of all these cash flows as well.
$14, 15453.
Yes, 1415453.
453.
1190, 409. Maybe you can start doing it from below. I'll do the above. This is 995006. This is 827,925. $682,860. Are you done with the calculations below?
No, sir, I am adding from top to bottom.
Okay, 558,920. Or the 921. That's, I think, 452,010. That's 360,525. If somebody's taken the total, please do the needful. I think I've done all the calculations.
64 lakhs 83,109.
64,000.
83,109.
Wonderful. So my step number 1 and my step number 2 is done. We've organized the data in terms of the present value. Anything else? Let's see if there is any TC. So is there any TC on renegotiations done? I don't think so. That was only at the inception. So there is no TC. Otherwise, we would have added this up as well. Now we are ready to go to the step number 3. So let's take the variations between the two percentage, step 2 and 1. So let's take the difference 64, 83, 109 minus
minus 56.
24,760 over the base of 56, 24,760. Let's see the percentage variation in this case.
83,109. Sir, it's a 13.24 percentage.
So 13.24 percentage, which leads to the fact that we're applying the extinguishment accounting.
Yes, sir, because more than 10 percentage.
Yes, there is more than 10% variation. So this will be extinguishment accounting. For this now, the book value is already organized. So now life is a little more simpler because we've already organized the book value at the very start itself. So I think for this, I'll have to slightly make a change because I have assumed that I made a payment of 19 lakhs as well. So please add 19 lakhs to this and please change the balance CD because I've taken the presumption that they pay the interest and the principal both.
Okay, sir.
$56.22, 909. Correct. That's, I think, 56.22, 909, I think.
Yes, sir.
Great. So now we can proceed to the entry. So now with this, we go on to the entry for extinguishment accounting. So the entry for the extinguishment accounting, let's first write down the generic entry. So in terms of the extinguishment accounting, the entry becomes financial liability. Old one gets a debit. What was the book value which we calculated? 56.
Not in mind.
Okay, no problems. 5622,909. 5622,909. And we calculate the financial liability, new one at a fair value. Can I pick this from step number 2?
Yes, sir.
No, that was an original EIR. We need
No,
at
no,
the
no.
new EIR.
Yeah, right, sir.
New.
That's right.
We need to calculate the new AR.
Correct. So let's go back and see what was the new EIR given to me. I guess I am not given the status of the new EIR in this case, I think. So I think I'll have to consider maybe 15% as an assumption. No new EIR is given, I guess. No.
No, only 15%
So we're
rate
not
of
given
interest
any
is
new
given.
EIR. Okay, so let's consider 15% itself. So what is now the, okay,
Sir,
rather, I think the best presumption would be to maybe take the same value.
sir, whether we
So
need to compute the EAR on this case?
not really. I think we'll better take the presumption that considering that the step 2 value is taken as same, considering the new EIR is also 10.8, I think that goes with a simplified assumption. 6483, 109. So I'm taking the same figure, though this is to be taken. So I'm considering the fair value picked up from the step number 2. Now let's see the balancing figure in this particular case. I think we're getting a balancing figure on the debit side. That would be in the profit and loss, the loss arising on the extinguishment in this case.
8,60,200.
8,68,200.
No, 60,200.
Okay. 8,16,200.
860.
860. Okay,
Yeah.
860,200, that becomes the balancing figure taken to the profit and loss account. Great. So that takes care of the concept of derecognition of the financial assets and the derecognition of the financial liabilities in terms of extinguishment and in terms of modification accounting. The modification accounting doesn't really come in the exams as well, because once you fail the 10% test, then the only thing is that you just need to put the entry for the TC. Thereafter, there is a new EIR calculation. So you'll see questions coming in the exams also typically on the extinguishment accounting. But in any case, you have to first apply the 10% test and then decide the kind of accounting.
So there is a question, if I may ask.
Yeah,
So
please.
in this question we have assumed that we have repaid both the principal and interest. Whereas in
Yes,
question it was given that we have repaid only the.
correct. Though as for the language, I think since it says that I paid the interest, but I took a presumption that you paid a principal. If you presume that the principal is not paid, then the entire solution will undergo a change. Though I think even the suggested answer took that opinion, and they took the payment of the principal interest on March 21. Because otherwise what happens that your calculations for the 8 remaining installments will also undergo massively a change. So that
Correct.
can lead to a lot of technical calculations happening. So I think in the absence, the best and the safe presumption would be to presume that you paid the principal and the interest both.
So in a given question, we can do this change of assumptions up from the facts of the case. Like we are assuming something which is not there in the facts. So we are making an assumption on facts which do not exist. So
Okay.
can we do?
No, if you take that presumption, I will give you the course of action. You need to explicitly write the assumption in the exams that I'm going with a strict presumption that, the question says payment of interest, which means the principal payment is not made. But coming now to the point. The point is that in this particular case, I am renegotiating with the bank. if I'm renegotiating with a bank, I think it
I would have
logically implies that
repaid
because
the
of renegotiations, I will always tell the bankers that, okay, let me pay this money, but for the future, please adjust. Secondly, considering that if I don't consider the principal repayments, then I think my accounting treatment, you will agree undoubtedly, becomes very complicated indeed. So I think a presumption should be something which, eases your answer and not complicates the answer.
Sir,
So indirectly,
sir,
yeah.
and also the principal is not repaid. For example, as per the NBA norms, it's not paid in 90 days norms is there.
we
It
won't
account called for
into
NPA.
that. We cannot get into that.
No, 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 no. That would be too much indeed, too many presumptions on that. I think your assumption should always lead to simplifying solutions and not making it complicated. So, what I'm coming to the point is that if you say the principal is not paid, your assumption is leading to complicated accounting. So, I think it's better to take a presumption which eases the solution. So, if the question is silent, take a presumption that makes life easy. I hope you got my point, right?
Yes, sir,
And
but however, the present question is valid, sir, actually. See, in the fact of the question is given is clearly only this interest is paid, then why we are not considering the interest alone?
No, no. You see,
See,
in any case, as I
you
said,
see,
your presumption is to make yourself, ease the answer, not complicate that.
no, sir. In this case, we are deviating the answer to the question of the ICAI, the question.
No, 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 not really. You see, if it says I paid interest, it didn't say that I didn't pay the principal. So you have got a presumption to presume that yes, it is not paid or yes, it is paid. So what is a better assumption? Take that as an assumption, right?
okay,
Right,
sir,
sir.
fine.
Right, sir. Okay, sir. Fine. Thank you.
And sir,
Right.
on the new EIR, which we did not calculate in this case,
That was also taking an ease assumption because since I'm not given the market rate of interest prevailing, but I think I can always presume, if in contrary to what I've done, that since you've renegotiated at a 15% rate, let's consider that to be the market rate, and you could consider the fair value based on 15%. But that adds another working point for you because you'll have to make another sheet for all those 8 installments and calculate at 15%. So that presumption will also increase your workload. So your assumption should be to ease yourself again.
we can always do that, provided it is allowed to do that. We are allowed to do that.
You can, of course. But my advice is that take a presumption which eases the solution, which eases your work, and that goes safe. So that goes safe. But you can take 15% alternatively, calculate a fair value, and do the entries accordingly.
Thank you. Thank you very much.
You're most welcome.
Yeah, thank you, sir.
Thank you. You're most welcome. So I think that brings us to the end as well. So I think next session we're going to cover the other special issues like impairment and the concept of hedging and the derivative accounting in this particular case. So see you in the next class, friends. Thank you very much. So I'll see you on Friday. Bye-bye
Thank you.
and take care.
Thank you. Thank you.
Thank you,
Thank
sir.
you.
And
Thank you
one
very
more
much.
thing I would say that financial instrument is beautifully drafted considering all the aspect.
That's right. Right.
Ma'am
Thank you very much.
ma'am was here, no, I believe. No, she's not here.
Haji, thank you.